Welcome. Thank you for being here today. And the nature of this panel is really about startups. And by startups, we mean ground zero. So a number of you, sometimes when you get to traditional lenders, you're faced with what's your track history? Have you, where's those 2 years of financial projections? And the fact of the matter is, if you're growing and you're starting from ground zero, you still need some funding, especially we just heard from 2 people who were growing on a fast trajectory. They needed money to really get it going and scaling. So what we're going to do with this panel very quickly is there are a number of these people on the panel who have used equity to ramp up their business, and other ones have used debt. So we wanted to give you an overview of what are the parameters that make you ready for equity or debt in a startup situation. So I'm going to pass it over to Mark Ackler. Mark has been a VC, a serial entrepreneur, and he recently led innovation at Redbox. But give us your overview on what do you need if you really want to get equity? Why is it different than debt?
So if you're interested in equity, first of all, you have to understand who you're asking for money from. So not all equity investors are the same. There are different size firms, from angel groups all the way through the very largest private equity firms that have multi-billion-dollar investments, and each one of them have a different investment thesis and philosophy. So it's really important to understand who you're talking to and what their investment thesis is. So typically, if it's an early stage venture capital firm, they have a thesis that could be sector specific. They could be interested in technology deals or medical deals or bio. And so it's really important to understand what their sector is. It could be stage specific. They could be early stage investors. They could be later stage investors. So it's really important to understand how and what their sweet spot is. And it's actually pretty easy to figure it out if you go to the venture capital website of the particular firm. They're very clear in their website of what types of companies they're looking to invest in.
So I'm going to ask you one other question. One of the big things is that investors are looking for an exit. And what does that mean to the owner of a company?
So when you take money from a professional investor, you're taking their agenda. And their agenda is very straightforward. So they want to make a certain multiple of return over X return over Y years. Typically, they're looking for the classic, they'll say, is a 10X return. Most investors would be pretty happy with a 3 to 5X return. And they're looking for a return sometime in a 5 to 10 year time frame. And you also have to understand how venture capital firms work and what cycles they are. So a venture capital cycle typically is about 7 years. And are they making the investment at the beginning of their cycle or the end of the cycle? Because that also is really important in terms of their time frame and perspective for when they want to make a return. But an exit is either the business is going to be sold or it's going to go public. That's the exit. And the venture cap, if you're taking their money, you're taking their agenda, and it's very straightforward. They want to make X return in Y years.
And as an owner, you could be part of that agenda or not. So you really have to understand, if you're trying to build a company that you want to pass on to the next generation, equity may not be a starting point to think about. But if you see yourself doing multiple companies over time, equity could be absolutely the perfect one. So I'm going to go over to Sharon Schneider, who you saw on the screen. And what was interesting to you is that you were kind of going, I could have gone organically and grown this slowly, but I really wanted to ramp up, is what you decided. So you decide to go for the equity piece. So tell us a little bit how you did it and where do you think you're going to be in 5 years?
Yeah, I think we had the good fortune to participate in a program last summer, Accelerate Labs, which kind of educated us a lot about the differences.
And why don't you explain a little bit what an accelerator is?
An accelerator is very often like a 12-week boot camp where they take, it's competitive, they select maybe 10 companies, they give them some cash in return for a little bit of equity, but then they just pour resources on those companies, mentorship, education, networking, And at the end, it usually culminates with what they call demo day, where you get up and you have 10 minutes to pitch full of a room like this that is full of 500 investors. That would be Accelerate Labs demo day. And so over the course of those 12 weeks, you have to make quite a lot of progress, and you do. You sort of figure out which way your business needs to go. We ended up making a pretty large pivot, which you heard about in the video. And so after demo day, we had 6 weeks of track record. So it's not very much track record. But what we also had was we had begun relationships with these mentors, investors, advisors who saw our track record as entrepreneurs and as a team. So it wasn't that we had this many months of sales, but they saw how we handled adversity. They saw how we dealt with challenges and roadblocks and overcame them to make the business better and stronger and flourish. And I think in those early days, those investors that we did a convertible note, they were investing in our team much more than in the business model as it was at that time. So that's going to change. They always say, I bet on the jockey, not on the horse, and I think that was really what we benefited from.
And where are you in your fundraising right now?
So we closed a convertible note last fall. That was sort of a bridge, to help us implement our new model, which was the resale, again, rather than sort of the Netflix kind of model where we owned it, but we just now sell it. So we raised that, but we're not cash flow positive. I mean, every month, that investor dollars is dwindling. So we're in the process of raising a priced round at the moment. So actually, we've been here today talking to how are we going to make those funds last until we can close a priced round, and do we need some kind of line of credit? Do we need some kind of short-term loan to help us get to until that equity round closes?
So I have to tell you, in the green room, she's already talking to Jonathan about that loan. So hopefully we'll have a deal tomorrow, right, between the two of you? That'd be excellent. Okay, let's go down to Paul Fehrenbacher. Very different type of business, medical device. If you went to a traditional banker, they may go, what? So tell us a little bit about your medical device and how you've been able to keep yourself going as you've built the business.
Sure. So the company Bradstreet, our technology is called SafeSnips. It was born out of an innovative program Northwestern has called New Invention Medical Innovation, where graduate students come together and identify an unmet clinical need and solve it, patent it, and then eventually every few years a company's formed out of it. We're fortunate to be one of the companies. And what our device does, it detects the presence of blood vessels in real time. So we'll integrate with existing surgical tools. So before a surgeon makes a surgical cut, they'll be identified to the presence, size, some other metrics of the blood vessel. Now, medical device sector is challenging. I wouldn't be able to get investment dollars at this time last year. So what we had to do, Linda, was business plan competitions. We did 3 business plan competitions, raised over $100,000 in cash and in-kind services, so we could hit metrics that investors wanted to see, such as our prototype functioning at the bench level, figuring out what our FDA regulatory pathway would be, getting a reimbursement strategy, some other inherent challenges in the medical device sector. And then we were able to actually approach some individual angels with medical device experience a few months ago. 2 lead angels invest in the company, and now we're talking to angel groups, one of which committed an investment last week.
And you actually won another business plan competition recently.
We did. We were fortunate to perform well at a large competition called the Rice Business Plan Competition in Houston. We were selected as the top life sciences company, and through that, we got additional $200,000 in investment and $50,000 in cash.
So there are a lot of business plan competitions around out there, so you may want to take a look at that because it's kind of an interesting type of financing, especially if you're starting up. So Paul, that really worked for you. Yeah. You mentioned angel groups here, and I'm going to send it back to Ira Weiss at the end, who's founded and led Hyde Park Angels, which is probably one of the biggest and most successful angel groups in town. So Ira, why don't you first define what an angel is to make sure everyone understands, and then how does Hyde Park Angels work?
So I guess we're called angels because, people write a check for an early stage company, and I guess I would think of it as an angel because when you write the check, you have no idea whether the money's coming back or when it may be coming back. But then you're also there to help out the company. And so that's really what an angel does, writes a check, and then, in some cases helps out the company. The way an angel group works a little different than individual angels is an angel group will be a collection of these angels who will collectively and sometimes decide whether or not to make an investment, and then the investment size can be much larger. And I guess what I would say about angel groups, kind of building on some of what Mark Ackler had said earlier, just thinking about, if you're going to a group like an angel group or any other funding group like that kind of group, looking at the other kinds of investments that they've made and trying to see how closely you match to those kinds of investments. Because as someone looking for capital, generally, it can be a very time-consuming endeavor, and trying to find groups that invest in things that are as close as possible to whatever your venture is. So in our case, Hyde Park Angels tends to do mostly software investments, although we will do some retail and other kinds of investments. They're usually investments where it's the earliest stage at a company's business, maybe a seed stage, or maybe the Series A, which is the first more institutional round. And actually, we're a group of Hyde Park Angels actually are investors in Moxie Jeans, so we're excited to see Sharon's progress.
So, and I'm going to just jump in here because we always talk about software and tech businesses, but in many cases, I look at tech as a means to the end, and so we have a baby clothes business here that is tech enabled. Scott's business, once again, is a shoe business that is tech enabled. So, the fact of the matter is there's a lot of business across all industries that once they're tech enabled, allows them to scale in a different way, which attracts more of the equity type of investment. So right now, you're looking, that's nice, you're looking at, you can also look at Paul and Scott, okay? Oh, Hyde Park, yeah, no. Sure, okay.
We've done some medical investing a little bit here and there as a group. And certainly, Scott, I know Scott, and I've talked to him before. A lot of times for groups like ours or even individual investors, if you're an entrepreneur, even meeting with the group or individuals who write these kinds of checks, even before you're looking for money, is helpful. And what's the old saying? You go to ask for advice and someone gives. You go to ask for money and someone gives you advice, and you go to ask for advice and someone gives you money. So you go in and you say, well, I'm not looking for money. I just really want your input on my business. And it's good to do that and develop a bit of a relationship with funders early on. So
cool. So I kind of want to switch gears here because we've talked a little bit about equity here, and hopefully you all come back with some questions on this. But the other thing is there's debt instruments as well that can come into play in a more alternative capacity. And Jonathan, I want to pass it to you because you're Jonathan Brereton, CEO, president of Axion Chicago. So tell us a little bit about how you look at deals and where you come into the mix.
Sure. I think just a couple rules of thumb, though. Funding for startups is difficult, period. I think especially on the debt side. So as a lender that's only investing debt really into small businesses, you've got to have cash flow. So a debt lender is looking for cash flow. You've got to have enough coming in to make the loan payments and keep the doors open. So inherent in that, there's going to be times where debt just doesn't work. So the cash flow has to work. I think pricing is always going to be higher as a startup, and that's something for everybody to always keep in mind. Investors or lenders are really determining pricing based on risk, and as a startup, your risk is higher than as a seasoned business. So cash flow is king. You can't repay a loan if you don't have cash flow. An investor, typically that's investing equity, is going to be more patient. So we're talking 5 to 10-year horizons. Our average loan term is about 18 months, so we're going to invest a small amount of money and we want it repaid relatively quickly. And if you have a long lead time before the business is generating the revenues or the profits or the cash flow is strong and stable, then it's very difficult to actually make a loan to that kind of business.
So I'm going to push you a little further in terms, your underwriting criteria is a little bit different than traditional loans. So how do you look at credit history? How do you look at collateral?
Sure. So as Axion, we are a micro lender. We're an alternative lender. There's a handful of different types of alternative loan products. In our case, we're more we look at all the same things a bank would look at, but we're more flexible. So A bank wants a credit score 680, 700. We have no minimum credit score, and we make loans to people with 500 credit scores. On the collateral side, bank wants at least 2 different sources of repayment, one of which might be liquidating collateral. Most of our loan customers don't have collateral that's a viable repayment source. However, we want them to pledge everything they have. So we don't want to make a loan to somebody that's not all in and doesn't have skin in the game. So we're going to look at collateral from that standpoint. But again, cash flow is the one place where we're not flexible.
Yeah. It's a really interesting program, and you're growing rapidly, and it's very cool. So, Scott Starbuck, City Soul Shoes. You actually started off retail, building out stores, in using more or less debt. And then as you switched the business, you really started looking at equity to grow it further. So just tell us a little bit how you approached debt, how do you approach equity, and what were the differences?
Well, we had a different scenario because we had brick and mortar and had cash flow. So we were able to go and get traditional financing and a line of credit. But as we grow, there's only so much that traditional banks are going to lend against inventories and so forth. So we've had to go outside the box and had some private lending and are looking for bringing on equity to help us finance our growth. So it's been interesting doing the traditional round, maintaining the cash flow to pay that debt and grow our volumes while we're shopping for equity partner or a financial partner to help us grow to the next level.
All right, so right now you are growing rapidly, City Soul Shoes. Have you raised funding, angel? What have you done, in terms of equity? Has it been angels? Has it been traditional?
No, we haven't raised angel money at this point. We have several people interested in fulfilling our first full round of capital that we're raising. But right now we're doing it through traditional debt financing. And we're pivoting from brick and mortar into .com. So we still have a thriving brick and mortar business, but the .com is what we're really growing and is growing, the fastest part of it right now.
Yeah. Cool. What I want to do just before we go to Q&A is go down to every person and give me what would be a tip to this audience of what not to do if you're asking for money, and what is the biggest help when you're asking money? If they're just the way you pitch, the way you approach people, is there any definite negative or a definite positive?
So on the positive side, I would say a great source to understand the venture capital community is to talk to the CEOs who actually have already gotten funded. So if you go to the website of the venture capital group, they'll list all their portfolio companies. Go to the CEOs, approach them. You'll find that they're very approachable, and ask them, how did they get the money? What's it like to work with this firm? I think it's a wonderful way to also get an introduction and in the front door.
Yeah, and I think this is really important. Is there some people you just don't want money from? One, they don't bring any strategic value to the firm, and sometimes they're just more onerous to work with.
For sure. Due diligence is bi-directional. You absolutely, money, I know it seems hard to get money sometimes, but money is just a commodity. When you take in venture capital, you're also taking a partner. And you want to make sure that you have the same values and you can live with that person.
Yeah. Anything that you find people, you were a VC once, what was the killer thing if someone came in and said to you something you'd said, there's no way?
I think coachability is the ability to listen, to learn, a little bit of humility. Once again, humility goes both ways as well. But I always look for somebody who is coachable, somebody who is willing to learn and listen. That's
absolutely key. Sharon, you've been in this process. Is there anything that you did that you've gone like, oh, I shouldn't have done that, or something that worked really well? As you prepared. I mean, you went through Accelerate Labs. I mean, what were some of the key things you learned there?
Yeah, I think I learned that there is definitely a difference between a small business and a startup, and that VCs, as we talked about sort of the exit and the people that want equity and that will give you large chunks of money, are looking for you to grow the business to be like $100 million business, that's not enough. That's not worth their time. If it's not going to be a $500 million business, a $1 billion business, at least theoretically, if you don't think you can get there, then they're kind of not interested in that. So you have to make sure that's the business you want before you pursue that. Because if, as Linda or maybe Mark said, if you want kind of a family, business and it's a nice $20, $30 million year, I mean, a lot of us would be really thrilled with that. And that's not the world that they're operating in. So I think it was a big education for me in terms of the consequence. You think money, great money, somebody's going to invest, but there's real consequences in the decisions you make and the risks that you take and the way that you operate your business that come from the kind of dollars that you take. So that was a huge education for me.
Yeah, absolutely. Paul, any ideas? I mean, you're been a very tough area in terms of just going through the medical process and everything else.
Yeah, I think the advice that I can give is across sectors, though. When Ira said seek advice and you'll eventually get money, potentially, rings true for Brightseed. Our 2 lead angel investors were mentors to the company for close to 6 months. And it was through that relationship that actually they asked to invest. We didn't solicit their investment initially. And so seek advice and build those relationships. And if you have a good idea and form a team around it, the money will come.
But I want you to know that took a long time.
It did.
So
I mean, what we did to bridge the gap was business plan competitions, one of which took place here today where someone could win $10,000. So if you can bridge the gap, fortunately, we were able to.
Yeah, very cool. Jonathan, you see all kinds of people who are asking for loans. What's something that just totally turns you off if they come in?
It's not terribly uncommon that we'll get a phone call from somebody saying, I want to start a business, do you have any ideas? And granted, that's an extreme case, but I think the more focused you are when you go in to talk to a lender, the better that entire process is going to be. I think I would agree with everything that's been said. Humility is important, coachability, all of those things, even from a debt standpoint. But you've got to be focused on what you want to do and what you need the money for, how much it's going to cost to purchase whatever piece of equipment. If you walk in with too wide open of an idea, a thought, it's really hard for a lender there's not much the lender can do, frankly.
Yeah, I think that goes with equity too. Sometimes we see deals and they're going like, well, we're going to do this, and then there's 3 other things, statutes we can go right off, and you're going, do these people have focus or not? They're going to be going 6 ways to Sunday all the time. So I think the focus, and then the devil's in the details. I know certainly when we talk to people, if they don't know their numbers, and I think you were mentioning that too, it's a big sign that you don't know what you're up to. Scott.
Well, I think the best piece of advice is surround yourself by like-minded people and people that have done the task that you're trying to accomplish yourself. Having great advisors, not just your lawyers and your CPAs, but advisors in other companies that have scaled a .com before and things they've overcome these issues and problems. And it's important. They've stubbed their toes before, and they know what to look for and what to watch out for. And that's part of the learning process, is really having wise people around you, people that you can just pick up the phone and chat with, that have overcome some issues. And that's kind of what the entrepreneur spirit's all about, is continually pushing on and overcoming these issues, and then getting up the next day and doing it again. Really, I think that's one of my best things that I'm practicing is surrounding myself by people that can help me overcome issues and move forward. And some people are like, oh, this is easy. You can just do this and this, and it's not a problem. And sometimes they're like, let's think about this together for a while and see how we can fix this issue. So that's what I think has been a great asset to me and my growth, is to have people that I can communicate with, that are mentors, that ask for advice, get money, and ask for money, get advice.
But I think this is a really big point, because when we look at advisors on teams, if you've had the resourcefulness and the network to pull in really strong people, it says a lot about you and the team that you're going to build for the future. So that's number one. The other thing that you start making a comment on is that advisors are really good if they've gone through the same growth period that you want to go through. So if you want to grow your business from 1,000 to 15,000 or 20 million, sorry, take that down, 1 million to 15 million. If someone else on your team has done that and knows the hurdles about that type of growth, it's really important. If you might bring someone on from a corporate stage who doesn't understand that, that could be somewhat of a problem, though they could bring you as a customer. So there's back and forth. But look for someone who's been through that same stage of growth. Ira.
I guess a couple of thoughts. If you're going to approach either a venture fund or an angel group, which is, and I'll talk about individual angels in a minute, the discussion about advisors is really important because just like other sales calls, you really want as warm of an introduction as possible. So if I actually get an email from an advisor for our fund or someone that I know within the community who wants me to meet a company, I'm very likely to take the meeting, we'll do my own research before the meeting and very open to it. We also get kind of random emails from entrepreneurs and people looking for money. We'll also meet with them, but definitely more skepticism going in if they don't have an advisor who makes the warm introduction. I would say if you're approaching individual angels, similar in some ways, but really, in some ways, friends and family or people who know you and have worked with you in the past, either work with you or know that you are productive and work hard and want to back you. Those are always good signs. So I think individual angels are a little different story, but the closer connection you can have to them, the easier it will be to get to yes.
But you have to watch out for family and how family you do want, but talk about the kind of the investor, like credit investor element.
Well, yeah, I think definitely there's pros and cons to having friends and family invest. I think when I look at it from my angel group or even a venture fund hat, I do actually like to see that people have some friends or family who've invested because, it means the people who know them well are, trust them. There's certainly some delicacies because a lot of companies, early stage companies will fail. And so then, it can complicate your relationship with friends or family. So I think people, kind of have this complicated relationship with whether or not you should have people like that invest. But it also, sometimes goes to the confidence of the entrepreneur. Like I'm really so confident in this that I do have some acquaintances or family that have invested a little bit of money in me.
But there's this disclosure piece here that they really have to understand that they may never see this money back.
Oh, absolutely.
Right.
Absolutely.
And that solves the Thanksgiving table discussion immediately. Yeah. Anyway.
I think not just disclosure, but also, making sure that there's someone that can truly afford to lose whatever money they're investing in your business. So you don't want it to be their life savings, or you don't want it to be, someone who really can't easily afford to write a check like that.
Yeah, absolutely. So on that note, thank you very much, panelists, for coming today on this rainy day. Good luck to all of you.